What was the Dodd-Frank Act's impact on regulation? Imagine a time when the financial world seemed to operate with little oversight, and risks were often hidden behind complex deals. That all changed in 2010 with a new law that aimed to make the system safer for everyone. The Dodd-Frank Wall Street Reform and Consumer Protection Act was created in response to the financial crisis of 2007-2008. Its goal was to prevent another collapse by tightening rules and creating new watchdogs. One of the biggest changes was the creation of the Consumer Financial Protection Bureau. This new agency was tasked with protecting everyday people from unfair or deceptive financial practices. It gained the power to oversee large banks and financial companies, making sure they followed the rules. The law also set up the Financial Stability Oversight Council, which keeps an eye on the entire financial system. This council can identify risky firms that might threaten the economy and make sure they are properly supervised. The Federal Deposit Insurance Corporation, which insures bank deposits, was given more authority to handle failing banks. Instead of taxpayers footing the bill, the law introduced a process called orderly liquidation. This allows regulators to close troubled banks in an organized way, reducing chaos and costs. Banks also had to hold more capital to stay strong during tough times. They are now required to keep a minimum leverage ratio of 15-1, meaning they can't borrow too much compared to their own money. They also have to pass annual stress tests to prove they can survive economic downturns. These rules help prevent banks from taking on risky loans that could lead to failures. The law changed how mortgages are handled too. Lenders now need to verify that borrowers can afford their loans before approving them. This reduces risky lending practices that led to the housing bubble burst. Certain incentives that encouraged pushing borrowers into expensive or unsuitable loans were banned. The Consumer Financial Protection Bureau enforces these rules to protect consumers from unfair practices. Another major change was in trading activities. Banks are now restricted from engaging in proprietary trading, where they trade for their own profit. This is called the Volcker Rule and aims to reduce risky bets that could threaten the entire system. The law also increased transparency in derivatives markets, which are complex financial contracts that were largely unregulated before. This helps reduce hidden risks that could cause problems later. Corporate governance was also affected. Shareholders now have a non-binding vote on executive pay, making companies more accountable. Credit rating agencies, which give ratings to financial products, face more oversight to improve their reliability. This helps prevent the kind of misjudgments that contributed to the crisis. Overall, the Dodd-Frank Act made the financial system more regulated and safer. It created new rules and agencies to oversee banks and markets, aiming to prevent another crisis. While it has increased compliance costs, especially for smaller banks, many believe it has strengthened the economy. It shifted the focus from light regulation to a more active approach, learning from past mistakes. The law continues to evolve as regulators find the right balance between safety and growth.